Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining us. Well, on tonight's program, Julia Lee of Berman Invest will look at the regional banks and also the big energy company Woodside, with experts tipping a higher oil price is on the way. And then Adam Dawes of Shaw and Partners will give us his best stock to hold for a year to make money on. And then Paul Rickard looks at Transurban with this buyback. Should you participate? And is this a company? Is it a dead set winner going forward? And then hedge fund manager Marcel von Pfyffer of Arminius Capital tells us how scared we should be about an Evergrande financial fallout, and he gives us his best local stock to buy and hold. That's the show. Let's start off with Julia Lee of Berman Invest. Okay, before I get you to look at some of the stocks that viewers have been asking me to look into, is there anything you've liked recently and you've added to your fund?
I guess having a look at the market at the moment, and we have seen a little bit of weakness in September. We came into September expecting a bit of weakness and about a 30% cash level. We've spent most of that, so expecting to see a good October and into year end. I guess looking at a lot of the stocks I like, I've mentioned them on your show. So I think we mentioned New Farm a couple of weeks ago. That's rallied about 10% from when we were talking about it. I guess having a look across some of the stocks, we've spoken about Qantas many times, and that's doing extremely well on the market. I have added, I guess, some of the underperformers on the market. I feel like they're just oversold at the moment. So IOOF and Magellan fit into that group in the financial sector. But in the financial space, we have Bank of Queensland as well as Virgin Money that have been doing well on the market. Yeah, I guess it's been a pretty good month. We're in the black, even though the market's in the red this month.
So when you said Virgin Money, is that the VUK ticker code?
Yes, so VUK, over in the UK, I mean, they're talking about inflation and possibly raising interest rates. And we know that rising interest rates is a good environment for the banks because it gives them an opportunity to reprice their mortgage books. So VUK, I guess, just exposure to a bank in a different country. So a bit of diversification through the ASX. It does trade on the ASX. It's the old Clydesdale, which was a spun off NAB, but now has rebranded as Virgin Money.
Yeah, courageously Maureen bought that not long after the coronavirus crash. She's made a lot of money, but
very good.
This is a big gamble, but she got it right. All right, so, and also we have noticed that the market is really getting excited about news of the international borders opening up with the likes of Webjet and Flight Centre and Qantas, as you already pointed out. They're all doing well, and you start wondering, how high can these go when we actually do start traveling big time, say in the middle of next year?
I think this is one of the funny things about the market, Pete, is that it prices in the future. So by the time we're traveling, it would have already priced that in. So really you have to get in on these names before it's priced in. So looking at some of those travel names doing extremely well on the market, I suspect there would have been some short covering on the market as well, given that we've seen names like Flight Centre and Webjet up about 7% and also Qantas up around about 4% on the market today. So look, I think initially we will see I guess a lot of us traveling. So I think initially the capacity for travel will be higher than COVID-19, and then we'll probably see a bit of an easing back. But the time to get in on the travel stocks is before we start traveling, because once we start traveling, it's all priced in.
Okay, let's go to a company like Pro Medicus, which you've mentioned before on our program. Do you still like it?
Yes, I really like this company. In fact, I think it was September 2018 at the ASX Small Mid Cap Conference. This was my number one pick. But back then, Pete, the price was $10 and now it's closer to $60. So although I really like this company, I don't like the price. So I probably wouldn't be buying it at these levels. For anyone who hasn't heard of Pro Medicus, I guess it's in that area of imaging. So in the old days, you know, we used to get our x-rays and take the physical x-rays to the doctor. Well, whereas Pro Medicus has technology that allows high resolution. So instead of having to take that physical x-ray, it can be sent over to the doctor instead. It makes a lot of sense, a huge growth area. But look, this is now like a $6 billion company with, I guess, $70 million worth of revenue. So I think the price is just too expensive for me to
Price
buy
to imperfection.
Sorry?
It's price to imperfection rather than perfection.
It's priced for perfection and too much growth. I don't think you'll be able to grow at the levels that are priced in. I'd like to see, I guess, a bit of sideways movement and consolidation for a while here.
Okay, now what about Splitter?
Yeah, look, the time to get into things is when I guess there's a new area and you're increasing market share. But unfortunately, in the area of buy now, pay later, there's more and more competition coming in. And when there's more and more competition coming in, it means that it's harder to get market share and it becomes more expensive. So you have to spend a lot more on marketing to be able to try and find growth. So look, I'd be avoiding a lot of the buy now, pay later space, given that there's still increasing competition and intensifying competition as well. In fact, Pete, today I was just reading about Covermore, which is buy now, pay later in the insurance space. So not only is it in the retail shopping space, but it is spreading to other large items as well.
Okay. Now you mentioned BOQ and you said you got that in your fund, but what about Bendigo Adelaide Bank? Have you run your eye over that?
Yeah, I mean, I like both of the regionals because they have been growing above system, which means that they've been, I guess, beating the big four banks when it comes to things like mortgage lending and mortgage growth. But I prefer Bank of Queensland. I mean, if you have a look at any of the numbers, it looks like there's been a lot of migration from New South Wales and Victoria into Queensland. And given that Queensland hasn't had the mobility restrictions that we have in New South Wales and Victoria, the property market looks stronger in terms of volumes as well. So look, I like Bank of Queensland for the flexibility that they have in terms of pricing, the strength of the Queensland economy and how they're getting through COVID-19. Whereas with Bendigo and Adelaide, I do feel like that the margins might come under a little bit of pressure and that might drive some of the share price. So still like Bendigo and Adelaide, but much prefer Bank of Queensland here.
Okay, finally Woodside. And we now got the BHP deal with Woodside. We know oil prices are allegedly going to be on the way up with a booming global economy next year. But what's your view on Woodside?
Yes, we have Woodside in the portfolio. We started accumulating just below that $20 mark, waiting for a turnaround in the oil price. And finally, it's here. The good news, I guess, for oil and energy companies, and not just Woodside, but Oil Search, Santos, Beach Petroleum, is that energy prices are just booming at the moment. Part of that has to do with the natural gas price. Over in China, they're already seeing blackouts. And of course, we've seen the Chinese government asking some of their industrial firms to cut back on usage, but now also households as well are being told to try and use natural light instead of turning on the lights. And this is all before peak season when winter hits. And then over in the UK as well, it looks like they've got an energy crisis there. One of the pipelines from France hasn't been working, and there's also been nuclear power that's been out as well, which has impacted. So energy prices are absolutely going through the roof. And then add in the effect of Hurricane Ida that we're still dealing with, that has meant shortages in terms of the energy supply, and of course reopening economies. And I think that energy price is really going to stay strong until at least the end of the year and going into the new year as well. So look, I would be accumulating here. I know that Woodside Petroleum has increased quite a bit over the last few weeks, but I think that's just going to continue on. So looking for a target price around $27 to $30 here for Woodside Petroleum, and oil and gas in general looking quite strong, not only from a cyclical, but also a structural point of view.
Yeah, and also, Julie, I've just been thinking, I just saw our household bill. We've been working from home right across winter. As a consequence, our heating bill is higher, our lighting, all that sort of stuff. And a lot of the offices would probably have kept up their usual demand. So energy demand is actually higher right across the board because of coronavirus.
Yeah, I mean, we're luckier over here in Australia that we have so many producers, but over in the UK, it's a real crisis. But I think the funny thing about commodities, Pete, is that, commodities are commodities wherever they are in the world. So as long as you can ship it somewhere, pricing does seem to be on a global basis rather than a local basis. So definitely our oil and gas companies are benefiting. And as you mentioned, the fact that we're working from home, there's a number of companies that are benefiting, whether it's energy companies, whether it's telecom companies, broadband internet companies, office companies, they're all benefiting from us working from home.
Yeah. Julia Lee, thanks for joining us.
Thanks, Pete.
Well, joining me now is Adam Dawes of Shaw and Partners. Adam, thanks for coming on the program.
Yes, great to be here. Great to see you.
Yeah, same here, mate. Now, look, I've asked you to just go looking through all the stocks out there that you guys are looking at all the time and analysing and talking to your clients about. What is the one stock you really think's got the propensity to do really well over the next year? It'd be like the Adam Dawes destroyer stock.
Yeah, so the best stock that we've got in our wheelhouse at the moment is Global Data Centers. GDC is the stock code. Basically, it's a global data center, but where does all the data go, Peter? That's what we want to know. Where does it all go? And it has to get stored somewhere. It doesn't stay in the cloud where everybody thinks it gets stored. It gets stored in data centers, and that's exactly what GDC does. They've got some data centers in Guam, in South America. They're across the world. They've just raised $25 million. There's no need for them to raise any more money. There's an SPP. Once that SPP finishes, I think this stock will really, really go. And I think it's a warehouse of the future and future-proofing your portfolio.
Oh, gee, that sounds like a real tagline. SPP, some people wouldn't know what you mean by SPP.
So it's a share purchase plan where existing shareholders get the ability to give the company some money at a discounted price at $1.93 at the moment.
Okay, so that's the one. GDC, so it's like a version of NextDC with a more international focus, I guess you're saying.
Correct. Yeah, NextDC is going to struggle to get a lot of in these metro areas because the rent's so expensive and property values are so expensive. They're going to have to pay up to get these warehouses, where these guys have gone, let's go outside of Australia and we can get some warehouse space a lot cheaper.
Yeah, real estate in Guam, probably a little bit cheaper than Sydney and Melbourne.
It certainly is.
Okay, let's go to, I've asked you a number of stocks, and these have been put to us by viewers who asked us to have a crack at it. Now, this is one that comes up a fair bit, and it's fairly popular, and it's a Promedicus, PME. Come off the boil recently, but it's had a pretty big rise over the year, hasn't it?
Yeah, it has. And Goldman, the reason why it did come off the boil, Goldman Sachs actually downgraded the stock. And so that's hence why it's just come off the boil a little bit. But Promedicus remains well ahead of its competition, and the gap appears to be a widening on this one. I think the stock trades definitely at a high multiple because it is a growth company, but there's clearly a case for buying the story and getting some more blue sky in this share price at the moment. Their addressable market's definitely expanding beyond the radiology and AI revenues, and they've won up to 6 new contracts this year alone. So contract moving forward, I think there's a little bit of blue sky left. I think they're uniquely placed to play a major role in the adoption of AI across the radiology and the imaging space. And that's why I think most of the market likes it. Had a bit of a pullback at the moment, potentially, a little bit of a breather, and that's always good. But PME is definitely kicking some goals in the market at the moment.
Yeah, and healthcare, we don't have a real lot of companies in that space, and you can see a lot of people jumped on the basis that it looks like a real improver.
Yeah, well, also infrastructure. I was looking at them today. We don't have a lot of infrastructure stocks either. They're all getting taken over at the moment. So there's a real gap in the market for good healthcare stocks, good infrastructure stocks. Yeah, definitely.
Here's one, split at SPT. I get the question on this all the time. I guess people are trying to look for the next Zip or Afterpay. What do you think about split?
Look, I think it's good technology, able to use your credit card, able to use anything and then split it into 4 even payments. I think it's fantastic. And they do have a very large following in the US. So again, that's a very large untapped market. I think Afterpay's only scratched the surface by about 10% penetration. So look, it looks fantastic. What you need to look for in Split It is the penetration and the website searches. But Afterpay and Zip, definitely with QuadPay for Zip, they definitely take the lion's share of that sort of search tool techniques to move forward. Look, Split It does trade on a higher multiple. I'm of the view that Zip is the better of all of the buy now, pay later businesses. Afterpay will certainly leave our shores. It'll go off to the US. That will make Zip the #1 buy now, pay later stock in the sector. So I think that's probably the better way to go, is play Zip. But Split It does trade on a higher multiple, hence why I'm a little bit cautious about it at the moment.
Yeah, and I guess the story around Zip going into India is an interesting one as well. There are a lot of customers in India.
There are a lot of customers, as well as quite affluent customers also, that are moving into that space with their middle class moving up the levels there. And yeah, it was absolutely well received by the market. I didn't think it would have done so well, but very well received. And even today, the stock is starting to stay in the green, which is fantastic.
Okay, let's go to. I've followed this story up because a lot of people have been asking me, okay, if I commit to the CBA buyback, do I buy more CBA or do I buy other banks? And I thought, well, let's have a look at the other banks like BOQ and Adelaide Bendigo Bank. What are you guys thinking about those two?
Look, certainly I've always been the view that I prefer to be in the big four. Okay, like that for me is the place to be. One, they've got the market clout. Two, they've got the volume. And three, they're a price maker, not a price taker. And when I say that, when Bendigo Bank goes to borrow some money into the market or overseas, they're much more of a price taker. They'll take what they can get, whereas Commonwealth Bank goes out to the market and they can make their own price. So there is some subtle differences between the big four and then the regionals. But look, certainly Bendigo is actually probably the one that is looking a little bit better. I'm a bit cautious on Bank of Queensland with that ME Bank acquisition. There's been some issues going on in there, and I don't think they've fixed that just that right. I think Bendigo, their results were good. It did sort of fail to impress the market going forward, but I think that Bendigo is probably the one that is better placed. If I was pushed to say which one's a buy, I'd say Bendigo and Adelaide Bank would, for me, trading on a lower multiple, good dividend, and I'm pretty comfortable. But in saying all of that, I prefer the big four because I think the housing market is still going to continue to keep going. And, I think the big four are a better place to be.
Okay. Last one, Woodside. I know a lot of my subscribers would love to see Woodside up near $30. But it's been a disappointing company. But they've got this BHP deal out there where basically BHP wants to, shovel its oil assets, energy assets into Woodside. It has to be supported by BHP shareholders. But the market's kind of liking it, and energy prices, the outlook's good there. But what's your view on Woodside?
Yeah, look, Woodside has been my favourite stock of all of the energy producers. So first of all, tick, it is the biggest, it's the best, and has the best balance sheet. So for an investor, that's where I usually gravitate to, so Woodside. Secondly, the stock will always follow the oil price, and the oil price at around $70, $75 where it is today actually looks pretty good, and Woodside's somewhat caught up with that sort of price rise on the oil side. Yep. The other side of it is this ESG trade is going to continue to happen, and Woodside has been definitely falling behind on that ESG side of things. In saying that, I think that Woodside and the BHP deal potentially looks a little bit better for BHP than it does Woodside at the moment, due to the fact that BHP is probably getting rid of some of those assets that they know that they can't become carbon neutral. But on the other hand, Woodside's picking up A-class, world-class asset that doesn't come around often. So, there's this sort of tug of war, I think, between ESG as well as the tightening gas market in Europe. There's certainly, I think, further upside in that LNG space as well. But I don't know if Woodside can capture all of that upside at the moment. So I think it looks okay. I think 85% of the world's needs is still done by fossil fuels. So we still need oil. And the other side to that is that there is not enough production process going forward, or there's not enough new mines or enough new wells being produced at the moment to supply the demand going forward in the next 5 to 10 years. So that actually bodes well for energy businesses now that are in production. Yeah. So there's lots of moving parts, lots of juggling there. I think Woodside's a buy. I'm comfortable with it. You just have to have that ESG side of things that you need to be cautious of. So, yeah, I like it.
ESG, you're basically saying the environmental, social and governance issues means that some fund managers simply won't buy those assets where once upon a time they always did, because, as you said, it was the best asset in that particular class.
Correct. Yeah, and ESG, there's a wall of money coming. Yeah, I asked my daughter what she wanted for Christmas, and she said, "Oh, some clothes, but it must be ethically sourced, Dad, and it mustn't be made in a sweatshop," right? So this is my 14-year-old daughter telling me this, right? There is a wall of this stuff coming down the line that we're potentially not used to, but it is coming. So I think you got to have one eye open on that ESG side, but also the reality is that fossil fuels needs to be used to power the world.
Yeah. I watched a television program recently called White Lotus, where the teenage kids were continually criticising their parents, and the mother eventually responded and said, "How come if you're trying to save the world, all these people in the world, but you're so horrible to us, the people who love you?" I guess our kids are showing us the way, mate, and that's a good thing.
That's it. Yeah, absolutely.
Adam Dawes, thanks for joining us.
Thanks, Peter. Have a great day.
And that was Adam Dawes of Shaw and Partners. Now joining me is Paul Rickard of the Switzer Report. He also talked about Transurban. I'm often wondering whether Transurban is a good investment now or not. It seems to be taking control of all the motorways and tollways and whatever in Australia at the moment. But it's also got a placement for capital raising. So let's just see if Paul thinks this remains a really good company. Paul, thanks for joining us.
Thanks, Peter.
Let's go fill people in on what Transurban is up to right now.
Yeah, look, it's part of a consortium called Sydney Transport Partners that have bought the remaining 49% of WestConnex. Now, if you're not from Sydney, that's a big motorway project that's essentially linking the M4 with the M5. So you sort of have another sort of continuous route through the heart of Sydney. It joins the sort of the southwest, the airport, Port Botany, up with the big sort of industrial and residential areas of the western suburbs. So it's a big motorway project. Transurban and its partners already own 51%. They've bought the remaining 49% for about $11 billion. Transurban owns 50% of the partnership, and it's raising about $4 billion to help fund its components. So it'll own and operate the motorway, but this is actually taking ownership away from the New South Wales government.
Paul, Transurban has been historically a very good company. What would you say about its current share price? Is it at a good level, or would you like to see it drop before you recommended it?
Yeah, Peter, that's a good question, because it's clearly been impacted by COVID. And of course, the big change about COVID, of course, is that we all, and particularly in Sydney and Melbourne and parts of Brisbane, had lockdowns. The big sort of unknown with Transurban, and it owns, it's the major toll road company in Sydney, Brisbane and Melbourne. So essentially it's got almost a monopoly on the east coast of Australia, plus a little bit in North America. Is there going to be some permanent change about, how we commute to work going forward? And will that actually put a bit of downward pressure in terms of traffic usage? So the thing about Transurban is that the tolls, the prices it charges, if you're a motorist, you know this, they increase with more than a rate which is based on inflation, but it turns out to be more than inflation each quarter. So the toll price keeps on going up. It's all about the traffic usage. And if traffic usage goes up or stays the same, then revenue goes up, and that essentially allows it to pay a higher distribution. And over COVID, of course, because COVID came along, traffic usage declined and the distributions have declined. So that's sort of been one of the big negatives on Transurban. We all know that we're going to get out of lockdowns, but are we going to see something permanent in terms of the way we all work and what that means for the usage of motorways? And I guess if we'd raised that 2 or 3 years ago, Peter, that wouldn't have been an issue. We didn't think that was going to happen. So that's probably negative number one. And negative number two is it's currently, on behalf of the Victorian government, building the Westgate Tunnel project in Melbourne. That's a big project. There's a big contractual dispute going on between the Victorian government, the subcontractors and the developer. The developer, of course, is Transurban. Looks like they're going to have to fork out some more money over that. That's not settled yet, so that's sort of a bit of a negative. And thirdly, the price has gone up so much that the yields become sort of 3%, maybe 4% at best, if it can get its traffic back to normal, which is interesting, but not as compelling as it was. So it's sort of been stuck, around about this $14 level now for the best part of a couple of years, with ups and downs with COVID around it.
Now, I'm going to put you on the spot here because, you do actually put together portfolios for our financial planning clients. Are you going to be putting them into Transurban because it's like a safe harbour type play when you put together, say, 20 or 25 stocks into a portfolio?
Yeah, and that's exactly the way we used to look at Transurban, Peter, as a safe harbour type play. Very reliable yield distribution, and you could sort of pencil that one in, and very low volatility. So we used to have a lot of our clients in Transurban. As I said, I've changed my mind over the last year or two to be a little bit, not quite as enamored about Transurban as I used to be, simply because I think this risk about, how we end up working post-COVID is still out there. And, a lot of companies saying to people, their staff, that you'll never have to come to the office again. Well, so if that happens, maybe the demand for some of the motorway usage, which does tend to be directed towards getting people into the cities, might decline. I guess the thing that's making me just a little bit, sit up and take notice, Peter, is there's been such a huge demand for infrastructure stocks in the last few months, really led by our big superannuation funds, that really suggests that there's almost, there aren't too many assets left. And we've seen, a takeover for Sydney Airport, which is the biggest stock. And contrary to the share price, I think that's going to go ahead, Peter. That will succeed at some stage. Yeah. We've seen a takeover almost done now for Spark Infrastructure. And then we've got two parties, fighting over AusNet Services. And that's three infrastructure companies gone in the space of a couple of months. There aren't too many left. I mean, Transurban's left. It's the biggest. You can look at Auckland International Airport. There's another smaller toll road company that's focused in the North America you look at. And then that's about it. There aren't really too many other companies out there that allow retail investors, and for that matter, a lot of big super funds, to invest in infrastructure. So I think in some ways you follow the money where the money's going, and it's going into infrastructure. And I'm inclined on that basis to stay with my exposure to Transurban and take up my entitlements that is part of this capital raising.
And Paul, one thing I've never ever talked to you about or tried to test is that I kind of agree with you. The working from home trend could be a negative for a company like Transurban, but I then started to wonder when you're giving your answer then, well, a big chunk of the people who work in the CBD of Sydney come in by train or bus.
Yeah.
So they're not really, the drivers may well be people going, say, from Parramatta to, Ashfield or something like that. And they would probably still use the M4 in that respect if they're going to keep on doing that kind of thing. And so, and the tradies, of course, they have to move around the place. So I wonder if obviously Transurban's done that kind of work. We should actually push them to see what they think about the demographics of the users and the impact of the working from home.
Yeah, I mean, look, it's mainly lockdown impact at the moment. Of course, lots of things are on hold, but yeah, I mean, look, it may turn out to be a much less serious issue than I'm foreshadowing, Peter. I guess it only needs a couple of percentage, movement, and that does have an impact on the distribution. So I think what really, big super, Australian Super, you've got Industry Fund Management Group, you've got Q Super, you've got a lot of others. They're lining up to buy infrastructure assets, and you've got to think that they've probably worked through a number of these issues. Yeah. There aren't that many that they can readily touch. So I think that's giving a fillip to the whole infrastructure market, and that's why I've sort of gone from being pretty lukewarm. Not that I didn't like the company, Peter, just that I thought it was pretty fully priced, and it was a stock to sort of look at buying when it gets marked down a bit, but I'm actually sort of coming around and thinking that, the market is so hot at the moment. We know that interest rates are staying low for a long time, and yields are probably, when they do go up, we're not probably talking about huge increases. So, maybe, a 4% distribution per annum from Transurban, given that it's going to be low volatility, given that it's going to be, you know, you could say almost pretty secure, looks attractive to a lot of these big super funds.
And I guess they won't have to share money with the New South Wales government anymore as well.
I guess they won't. But don't worry, everyone gets the benefit, Peter. So you and I know as toll road users, we'll be paying. And I guess that's one of the reasons that why I know you as well have liked to own Transurban in the past.
Right. It's the reason why I like banks as well. If you can't make them do what you want, you might as well go along for the ride and take the profit and the high share price.
Yeah, look, it makes sense. It's the only way you can get even because you can't do much else, right?
You can't. Paul, thanks for joining us.
Thanks, Peter.
That's Paul Rickard of the Switzer Report. If you want to know more about what Paul writes, have a look at the website, switzerreport.com.au, and take out a free trial. Well, joining me now is the founder of Arminius Capital, Marcel von Pfyffer. Marcel, thanks for joining us.
You're welcome, Peter. Good to see you again.
Yeah, same here. All those years in Switzerland, what a place to be, but I'm glad you're back home in lockdown-free Queensland.
Yes, I'm sure it's only a matter of days before that changes again, Peter. Who knows?
Okay. Now, interestingly, you wrote a piece about the crackdown in China. It coincides with the problem we've seen with Evergrande, the property developer.
Yep.
What do you think Beijing is up to?
Well, first of all, let's clarify exactly what Evergrande is. It perhaps once was a property developer and then, of course, moved into shadow banking. And therein is really why, to answer your question quite directly, why President Xi and why the Chinese are having such a major issue with Evergrande and what we are touting to be the eventual controlled demolition of Evergrande by the Chinese authorities. So the problem is, Peter, again, as I'm sure you and all of your viewers would have seen over the past couple of days, the Chinese regulatory authorities never once to be known to be backwards in coming forwards, have decided to kill off all Bitcoin mining and Bitcoin trading. So this holistically is continuing the regulatory crackdown on activities that they see is not contributing to the betterment of the Chinese populace going forward.
Now, before all this, it looked like China was a communist country playing a capitalist game that essentially suited China. That's what it looked like, whether it was or not. Lately, it's become like a communist country that's cracking down on capitalism and basically picking and choosing what it wants to survive in the old form. Is that a fair call?
90% of what you said was completely on the money. The only caveat I'd put there on the remaining 10% is, as we note in the article that you've referenced that we wrote last week, China has always been a communist country, and I think hearkening back to the era of the Clinton presidency, when they were admitted into the World Trade Organization as a developing nation, and I'll just sink the boot in here that despite ostensibly still being the second largest economy in the world, even based on purchasing power parity terms, they are still classified by the World Trade Organization as a developing country, which affords them many advantages in the global trade arena that other countries who are deemed developed countries don't enjoy. So going back to your question, Peter, the West, when China was brought in to the World Trade Organization, the West thought that this would herald the reduction in some of the nastier or the more brutal tenets of communist ethos. However, as the years have gone past, as you said, what they've done very adroitly is that they have cherry-picked the components of capitalism that they actually enjoy and that has benefited the Chinese economy. And indeed, I think, again, we touched on this briefly in the article, but this is very, very important for your viewers, is the social contract that exists between the Chinese Communist Party and the Chinese citizens. And what they have done since their entry into the WTO, they have managed, with the assistance of the World Trade Organization and many other global organizations, they have managed to create an environment that has kept their GDP growth at levels that are the envy of every other nation on the planet, and the social contract that exists between the party and the population is that the people are prepared to give up certain benefits or certain freedoms that we in the West take for granted in return for that colossal GDP growth of anywhere between 8 and 10% as they've enjoyed. And so what has happened is that the Chinese population has clearly benefited from that, and the contract has been is that they have something like 600 million people in their population who are making still today, who are making less than $200 per month. So the social contract is they will give up a certain degree of their freedoms and rights in return for the lower class, or the uber lower class, as the West would deem them, to be moved across into the middle class. So Peter, yes, they have, the Communist Party has been able to say to the West, we're doing all these good things over here, but realistically in China, that has still come at a price. That is to say that the Chinese people still do not enjoy the freedoms that we in the West, as I say, take for granted upon birth.
Okay. Let's get away from the bigger order issues that you're always concerned with, because you're a bigger order kind of guy. Let's go to, is Evergrande a potential Lehman Brothers? Could it rock the global financial system?
We don't believe that it will be a source of contagion to the West. As we've written about earlier this week, the global high yield market, that is to say all of the global institutional investors, have less than 5% allocation into Chinese high yield. So the likelihood, and again, that is a very specific number. When you look at Lehman Brothers, which is the obvious comparator here that many commentators are hearkening towards, when you look at Lehman Brothers was a bank. It was. Lehman Brothers was what would eventually become known as a globally systemic important bank. Okay, so post GFC, they now they grade the credit risk and the solvency and the liquidity of these big guys regularly. Lehman Brothers was a bank. Lehman Brothers was not some Californian property developer. Okay, so Evergrande, we believe, is a problem that is inherent to the Chinese economy, not just to the Chinese property sector. It's going to have wider ranging ramifications to the Chinese market. But if your question about the comparison to Lehman Brothers, if that's where we're going, no, it's not. It's actually not a fair comparison. It's not a appropriate comparator. But is there going to be ramifications in Australia, perhaps, to what will, we believe, be a slowdown in the Chinese property sector as a result of what we believe will be an eventual controlled demolition by the Chinese authorities of Evergrande.
Okay. Would you invest in any company in China?
No.
3 or 4 years ago, everyone wanted to be in Tencent and Baidu and Alibaba. Have those days gone? It's just, has Beijing become too big a sovereign risk for any investor?
From our perspective, yes. We point blank, as a matter of strategic policy in our company, we will not invest in any instrument that has direct exposure to China. I think, you've referenced Alibaba there. You should try and get Jack Ma on your show, Peter, if you can find him, if he's not locked up for being too rich. So the problem is, again, you and I, you've probably got 2 or 3 years of age on me there, Peter. But guys like you and I, we lived through the GFC, we lived through the tech crash. I was a young whippersnapper in 1987, but all of these recent, and I say recent because they, in historical terms, they are pretty recent. All of these recent crises have something in common. is that the market goes up at a seemingly inexhaustible pace, a la Tencent and Alibaba and all the other Chinese market darlings, to the extent that the regulators, and in this case, MSCI, Morgan Stanley Capital International, decided to include China or 200 Chinese stocks into its MSCI Global Index. We thought at the time that this was a terribly poor idea, and that has played out as you see today in global markets. So there are other commentators who I'm sure are very well known to you who refer to China as simply being uninvestable, and the repercussions of former President Trump policy about reducing US pension funds, reducing US institutional investment into China has been carried forward to the Biden administration. They'll be pursuing the same type of restrictions upon institutional mandates going forward. So again, if you're already invested in China, you're wearing the pain of the Evergrande fiasco. Would we invest, and do we ever recommend to investors to invest directly into China? No.
All right, so 2022, what's your economic outlook and what's the market outlook for Arminius Capital?
So the market outlook for 2022, again, provided that the global leaders, and I think that in the Northern Hemisphere, they're probably handling this a little bit better than in the Southern Hemisphere, provided that they continue their current policies, they have decided, led by the UK pretty much, and I mean, Switzerland did it as well, but Switzerland only has a population of about 8.5 million people, so it doesn't really register on too many people's radars as far as global policy is concerned. But they have just decided that enough is enough, that if you want the vaccine, go and get vaccinated, and then we are going to open for business, because the long-term effects that are yet to be felt, because they're long-term effects, the long-term effects that are yet to be felt in the population, in the economy, but also the mental health of people going from lockdown to opening lockdown to lockdown, etc. They have just decided enough is enough, and let's go forward. So with the caveat of another hyper contagious variant breakout, which will happen, which could happen, because again, people need to understand it's a virus. This is what viruses naturally do. They develop new strains, but the health authorities, the drug companies, seem to be more on top of what's going on. So provided that the holistic health of the population is cared for, we expect some semblance of a return to economic normality, because they dovetail into each other, which is clear to me, but not to everyone. Then we're expecting that, provided that the EPS of all the companies continue apace, that 2022 will continue to be hopefully the uptick of the W rebound that we've experienced since February 2021. Now, the outlook for almost all equity markets, and again, you know, Peter, how much I hate using acronyms, but hearkening back to TINA, there is no alternative. The Federal Reserve last week on Thursday effectively said that they will commence tapering. They've managed to, under Chairman Powell, communicate this to the market a little bit better than Bernanke did in 2013. So you haven't seen this massive stampede for the Dawes in equities land. So I think they're going to be incredibly measured in how they raise rates in the United States. But again, TINA means that in Australia, you will have, just purely by holding the ASX 200, you'll have a dividend yield somewhere between 3.4 and possibly 3.6%, which isn't as good as in the old days, but this is where we are today. And in the US, Japan looks very cheap. And Europe, as I said, has probably been on the front foot of all of the major markets we look at, which is the US, Europe, Japan, and Australia. So in a nutshell, Peter, we are, I don't want to say cautiously optimistic. We are we are optimistic for 2022. Yeah. And again, even if the Federal Reserve and then obviously the ECB and the BOJ and the RBA follow suit and start to raise interest rates back into some semblance of a normal inflation targeting range. Even if they do that, then you're still going to see dividends in Australian companies. When we just look at what Bluescope has recently done in Australia, dividends, special dividend on top, leverage to the US property market, not to China. There are going to be robust quality names in Australia that even if they do start to raise interest rates next year, then we still think that equity markets are a far more sensible medium to long-term play for investors than in almost any other asset class.
You've been away for a long time, but what's your favourite local company going forward?
We like Bluescope. As I just referenced, I can dig into that a little bit deeper for you if you want. We also like...
I'll bring you back in a couple of weeks' time, we'll talk about it, but I just wanted to, for the people who've been listening to the higher end of your argument, they're probably interested to know whether they're happy to know you're pro stocks 2022 and you do have a local liking in Bluescope. But how about I get you back next week and we'll look at some of the companies you like? Yeah,
sure, absolutely. I'll give you a top 3 or a top 5, Peter. How does that sound?
I haven't had you for a long time, so let's go for top 5 next week.
Next week. Yep, cool.
Well, Marcel, thanks for joining us.
Sacre bleu, Peter. Take care. All the best.
Cheers, mate. And that was Marcel von Pfyffer of Arminius Capital. And don't forget, our small and micro cap conference, an online conference, is on tomorrow. If you want to attend, just click on the link in the description below. Thanks for joining us. See you on Thursday.